Goldilocks number, but certainly there's plenty of other information out there that suggests that the U.S. has joined the rest of the world in kind of a synchronized global economic slowdown, and that a couple of insurance cuts here over the summer into the fall make sense. You know, probably not a 50 in July. I mean, as Mike said earlier, that really didn't make a lot of sense in my mind anyway. But I think the Fed is still poised to cut, and whether they actually cut or not, we don't know. But my guess is that they will. And in a slowing growth environment, the payroll number notwithstanding, I think that kind of insurance cut with inflation running so much below its target makes sense here. And they can always take those cuts back next year if the economy reaccelerates.
Margie, I know U.S. equities are lower this morning, but in general, the moves to record highs that we saw earlier in the week, it could make the argument that the market has priced in this cut later this month. What happens if it doesn't actually occur?
Well, I think it would be a big mistake on the part of the Fed, just as they made a big mistake in December. So I think it's very appropriate. I'd be shocked if they didn't cut rates. And I think that that's why the market has done so much better this year, because of the Fed's sea change in January, when they totally reversed course on their upward march to say we need to step back and look at economic conditions for the level of rates that were not justified.
This late in the cycle, does a small cut or a small couple of cuts tend to actually work and then allow the Fed to stand back, or would this be the start of a change in direction that would persist for a number of years?
Yeah, I mean,
well, I don't think we're in a cycle.
Jurrien, to you.
Sorry. That is the great question, of course, right? Because if the economy is going into a recession, which I don't expect at all, then you could argue even if the Fed starts cutting, it may be too late, and then we're going into a bear market. But if we're not going into a recession, and our evidence suggests that there's only a 3% chance that the economy is currently in a recession, kind of as a nowcast, and if the Fed cuts rates against that scenario, it could really extend the cycle. And actually, I looked at this. If you go back to the 50s and you look at the cycles where the Fed starts cutting and the economy is still expanding at that point with a low odds of a recession, 5 out of those 6 times the market's up by an average of 20% a year later. And so it does matter. And if the economy reaccelerates, as it did in 2016, when at that point, the S&P was at the 100th percentile of its year-long range, while the 10-year Treasury was at the 0 percentile. At that point, it was Treasury yields that caught up, the economy accelerated, and the Fed was able to go back to kind of its tightening track, a year later, which is what it did. So I do think it matters quite a bit here.